Have you ever wondered why the cash flow statement is so crucial for any business? Stay until the end of this video and you will learn why. Most companies use what is called an accrual method of accounting as opposed to a cash method. With the accrual method, sales are booked when the goods go out the door, even if the buyer takes years to pay for them. With the cash method, sales are only booked when the cash comes in. Because almost all businesses extend some kind of credit to their buyers, companies have found it more adventurous to use the accrual method, which allows them to book the sales on credit as income on the accounts receivables on the income statement. Since the accrual method of accounting allows credit sales to be booked as revenue, it has become necessary for companies to keep separate track of the actual cash that flows in and out of the business. To this end, accountants created the cash flow statement. The cash flow statement will tell us if the company is bringing in more cash than it is spending, which means positive cash flow, or if it is spending more cash than it is bringing in, which is negative cash flow. Cash statements are like income statements in that they always cover a set period of time. Company accountants generate one every 3 months, and for the fiscal year, the cash flow statement breaks down into 3 sections. First, there is cash flow from operating activities. This area starts with net income and then adds back in depreciation and amortization. Though these are real expenses from an accounting point of view, they don't eat up any cash, because they represent cash that was eaten up years ago. What we end up with is total cash from operating activities. Next is cash flow from investing operations. This area includes an entry for all capital expenditures made for that accounting period. Capital expenditure is always negative number because it is an expenditure which causes a depletion of cash. Also included in this category is total other investing cash flow items, which adds up all the cash that gets expanded and brought in from the buying and selling of income-producing assets. Both of these entries are added together to give us total cash from investing activities. Finally, there is the section on cash flow from financing activities. This measures the cash that flows in and out of a company because of financing activities. This includes all outflows of cash for the payment of dividends. It also includes the selling and buying of the company's stock. When the company sells shares to finance a new plant, cash flows into the company. When the company buys back its shares, cash flows out of the company. The same thing happens with bonds. Now, if we add the total cash from operating activities with cash for investing activities, together with the total cash from financing activities, we get the company's net change in cash. What I have discovered is that some of the information found on a company's cash flow statement can be very useful. So let's roll up the sleeves and dive into the cash flow statement in the next few videos. Don't forget to subscribe to my channel if you would like to be part of this journey. Thank you and see you next time.